session, I'd like to invite my partner in crime, Rahul Somani. He heads the consulting at ESOP Direct and Capita. The session is titled Equity Updates, India and Global. So while Rahul would be sharing the India updates, we are joined by Tom Parker and Susanna from Tapestry to get us some global sense. So Rahul, welcome.
Thanks, Abhishek. Good afternoon, everyone. I think everyone has coffee or cookies. So today I am going to start with India updates. What are the legal updates around India? And our partner Susanna and Tom will take you through the global part. That what is the global changes happens in the near past and how it is going to impact your equity compensation plans. So I start with the equity updates in India. So first we need to see that regulations around ESOPs in India. So if you see, there are a lot of regulations around ESOPs, like there's a SEBI, FEMA, IRDA, Companies Act. So it gives that, okay, the structure will be very complicated, it looks like, but it is not. I take 3 C's from Venkat, which has given in the first session, which because of these regulations, actually it gives the credibility to your ESOP scheme, that it will work. It gives the certainty and it also gives the consistency that we are not doing anything wrong, anything out of the things which may impact the employee or the company in a wrong way. So I will take it these complexities more like it is a guidance for us, that maybe because the regulator has seen all the industries, and then they decide that they give a guidance that what is good, what you should do. So that's why these regulations are there. I will pick up the latest changes in these regulations. So first I start with FEMA. So FEMA means if Indian entity options are issued to foreign nationals. So now all plans comes under the ESOP. So for earlier there was only ESOPs was defined under FEMA regulations. So they use the word ESOPs, but now in recent changes they change it to any equity based compensation plan. So it's like if you issue equity settled SARs, if you are issuing RSUs, if you are issuing ESPP, everything comes under the same regulation. So that is an anomaly in the earlier I will say regulations, but it has been removed by FEMA, and they have given the guidance that all equity based compensation comes, the same regulation aid will apply to every equity based compensation which are giving to employees. This is also very important, and many times companies raise these questions that if the residential status change in between, if I'm giving options to employee who is a resident Indian, but after some times, because the vesting period is like a long period of 3-4 years, and if the residential status change in between, that what will happen. So it little bit complicated, but the regulators are very clear. They say you can treat them as a resident Indian. So it is a non-repatriable basis, you need to transfer the shares to them. So that is something they made it very clear. So there is no ambiguity there around, but they made it clear that what is the residential status at the time of grant is the most important thing in FEMA. That when you are granting to someone, what is the residential status for that. So this is something the more clarity regulators has given. If the foreign entity US issuing options to Indian residents, so now it comes under the overseas portfolio investment. So this is so if they are issuing less than 10% of their equity, it comes under OPI, which is more like a overseas portfolio investment, and employees can pay the money under liberalized remittance plan, which is more like currently it is $250,000 in a year, which is a huge number. So it makes them the easy way to transfer money as well, even if you are going for ESPP or ESOP plan, the foreign entities are issuing to Indian residents. The only thing they have made the reporting also very easy. They made it like a 6-monthly reporting. If the foreign entity is issuing equity shares to Indian residents, the local employer should file the returns to RBI by a half yearly basis. So it is like 31st March and 30th September. So even only the two reporting things they have given here. So in that sense, they made it like very much clear from regulator side that what they want and how you can treat and what reportings are required. That is very important. Moving, so this is something the SEBI has come out with a paper where they have taken the public comment. So this has been given by the expert committee that they suggested some of the changes in ICDR and LODR. So we just want to capture here that in the LODR side that they are treating the SAR also in a similar manner, because that is an ambiguity earlier in ICDR that there is no mention of SAR. Even the SEBI's other regulations talk about ESAR, but the ICDR does not talk about that, about SAR. So they have now made it like any the employee benefit scheme documents as per terms they have given. The one more thing LODR has given is that you need to upload your scheme. So that has been, expert committee has recommended that thing to SEBI board that the ESOP scheme should be uploaded on the website. So that is something they have given. In our view, it gives transparency, but it also, from the business side, it may not be rational, because some of the terms in the ESOP schemes are very particular to those companies. So uploading those things, maybe it may avoid a confidentiality in those plans if somebody has given the business plans in their ESOP scheme. So that is one thing. The second, we find this particular clause is more like a duplication, because we are already giving those details in shareholders explanatory statement and board note. But this has been recommended by the expert committee to SEBI board. Still the decision is pending, but this is something is in the public domain. Sorry, coming to ICDR. So ICDR, relaxation of lock-in shares, even for the bonus shares, has been given by SEBI. So earlier that was not clear that if the bonus has been issued on ESOP shares, what will happen to that. So ICDR has given that the bonus share has been also treated as a ESOP shares, and there is no lock-in requirement for that. Even the shares issued under ESAR will be considered as a SAPE. The last point which you see is the outstanding SARs are required to be fully exercised prior. This is something they have given that you can issue SARs, it can be outstanding till DRHP, but when you are going for listing, it should be exercised. Where we feel that it does not take the SAR to the same level of ESOPs, because where you are allowing ESOPs to be continued post IPO, but in SARs you are telling that it should be converted and the equity share should be issued, which is more like, does not give the objective of long term. So that's why there should be some parity should be there between ESOPs and SARs, that ESAR should also be treated in a similar manner like ESOPs. But currently this is the recommendations which expert committee has given, that SAR should be fully exercised, where we feel that the companies can find the practical difficulties as well, because if they issued the ESAR just 1 year before, then how they are going to convert it, because the regulations only said that there should be a 1 year lock-in period. So there are some practical difficulties here. Moving to next. So SEBI has also come out with the REITs regulations, where they have given the details to the REITs as well, that how the REITs should, if they are going with a unit equity based compensation plan, what are the things they should take care. So this is a new regulations which has come recently, just 3-4 months back, but it is applicable to REITs only. So this is applicable to all unit based benefit scheme. It can be run only through trust. The one thing they made very important here, that the trustees should be the debenture trustees. So they made it very clear in REITs currently that it is not in the SEBI regulation which is for the employee benefit, but in the REITs side they have given that the trustees should be debenture trustees only. Receiving units, so how the trust can receive the units. So they have also given the source, that how the trust will receive the unit, either from the management fees or transfer from the shareholder or manager. All other terms are very much similar to SEBI regulations. So they have changed the 3-4 terms there, but the other terms are very similar. So it gives a consistency that even if the REITs are going with a unit based employee-based compensation plan, they can follow the SEBI regulations. Plus, the specific to this REITs, they have given that it should be through trust and it should be through debenture trustees. RBI also come out 2 years back for the guidelines to to giving the compensation to KMPs in NBFCs sector actually. So not so robust like they have given for the private banks, but it's they have also considered here also that the risk is a very important thing when you are deciding the compensation for KMPs. You should consider the risk as well. So that is the intention we can see when RBI issued these guidelines for NBFCs in India. So this is applicable to KMPs and senior management. They have very clearly given that NRC will approve the compensation policy, which may include the mix of fixed and variable and also cash and non-cash component actually. So they have not given any specific thing, but they said that it is recommended, or I will say it is a suggestion that it should be a mix of cash and non-cash thing. So it is not directly given like a bank that how much should be the non-cash and how much will be the cash, but they say the mix is something which we recommend. So the all fixed payments may comprise of fixed and variable, where all fixed payments are like you get the every month salary and all, but they also said the variable where they say that it should be share linked instruments in NBFC. So this has been given by that you should have some part in share linked instruments, some part in cash, or mix of both, but they are not given how much. So there is no percentage given that this much percentage should be share linked and this much should be cash. But it is an intention what we can say that they want to avoid the risk, because ESOPs is also a payout risk where the employees are also linked to the growth of the company, the value of the company. So they want, that is the intention, but they have not described that how much percentage you should give. Means it can be 0 to 100 as well. But if they are writing like a share linked instrument, we suggest that it should be an intention to go with some share linked instruments. Sorry, I have some bad throat. You can. Sorry. Deferral of variable pay, very similar to what they have given to bank, that it should be deferred, but not if they have not defined any period as such, but they said that the variable pay should be deferred over a period of time. No guaranteed and no guaranteed bonus, that they made it very clear. It should be joining and signing bonus only, which is a one time to any KMP or senior management. Otherwise, they don't give any guaranteed bonus. They have also recommended modules and clawback clauses in NBFC. So they want that you should, when you are deciding the compensation policy for NBFCs, you should consider the modules and clawback clauses. IRDA has also come out with the equity-based compensation to insurance sector, to KMPs and senior management. So I run it through little fast. So they have given that what should be the variable pay, what should be your fixed pay, but they have mandated that how much should be from the equity settled or CSAR, and how much it should be through the cash. So they are giving very clearly in the insurance sector that how it works, and which may be very similar to RBI guidelines, but yes, different on some of the context, which is very particular to insurance sector. Quantum of ESOPs at individual level. So they have also decided, given that the quantum should be decided on the basis of the fair value of option. So you need to take out the fair value, and accordingly you can make a grant. They have given that 1% of paid up capital and 5% at any point of time. So they have given that how much ESOP pool you can make, but it is over a period of time. So they consider it that you should not be like giving very high numbers to the employees. They made a very ceiling that how much you can keep it for the ESOP pool. Modules and clawback. So modules is introduced and clawback has been redefined. So they have redefined the clawback clauses for the insurance sector. This is important. KMPs are no more entitled to sweat equity shares in insurance business. So they have given very clearly. And only joining and signing bonus, very similar to what RBI has given, but no guaranteed bonus. So there is no guaranteed bonus to the KMPs and senior management in IRD. Coming to tax and other updates. So this is important that the government has come out with a 20% TCS on ESOP or ESPP payment if you are making outside India. Above 7 lakhs, the company need to collect a 20% TCS on the same. But recently, the 2-3 months back in the amended budget, they said that this TCS can be adjusted against the TDS on the equity incentive plan. Difficult to manage practically, because if the employee does not have a income from the equity incentive plan, it can't be adjusted, and they need to wait till the income tax return to get the credit of this TCS. So this is important, but yes, the government has put this. If the money transfer from India to outside is more than 7 lakh under any equity incentive plan, the AD banker through company should collect 20% TCS on the same. So it is like a tax collected. Tax rate has changed. Everybody, this is very much in the public for many days. So they have changed the tax rates on the listed securities, where the tax rate has increased for long term, which is earlier 10% to 12.5% now, and short term is like 15% to 20%. So they have changed the tax rate for the listed entities. And yeah, buyback. So if the companies are going for buyback, they have changed it from capital gain or loss to deemed dividend. So that is something, is a new update from tax side, where they moved this income to under the dividend income. So the key takeaways is, I just want to put it that they have the regulators has bring more transparency. They have given more guidance to us, and I repeat that they want to go that your scheme should be that much creditability. There should be a consistency, and it should be certain. So if we are following the regulations, we are already giving the transparency to our ESOP scheme. So that is important, and the key takeaways. So now I request Suzanne and Tom. So I just briefly introduce Suzanne and Tom here. So Suzanne and Tom are joining us from UK. They are from Tapestry Compliances, a UK-based law firm. I was a global law firm. They provide law services to many countries. So Suzanne is a legal director with over 20 years of experience advising UK and global companies on share-based plans and equity incentive arrangements. She has supported numerous private companies in structuring equity schemes, particularly as they prepare for IPOs and transition into public companies. And we have Tom as well. Tom is a managing associate at Tapestry, specializes in global and UK employee share plan and executive remuneration. His expertise includes drafting plan, rules, and supporting companies as they expand equity awards into new jurisdictions worldwide. So let's welcome Suzanne and Tom to share their valuable insights. So over to you, Suzanne.
Thank you very much, Rahul. Hello, everybody. We're absolutely delighted to be joining you for this session today. I'm sorry we can't be there in person, but hopefully you can see us and hear us on the screen perfectly okay. So, Rahul, if you wouldn't mind moving on the slide, following your insightful updates on the position in India, we will be giving a brief overview of some global compliance considerations. So first of all, I will just give a quick introduction to us here at Tapestry. As Rahul has said, we are a UK-based law firm, and we specialise solely in equity incentives and associated variable pay initiatives. We have a large team of UK qualified lawyers, and we also work with a global network of advisors so that we can manage global share plan compliance for our clients. And our clients are based all across the world. Most of our work has a global angle. We also offer a legal and tax compliance database, which we call ONTAP. Tom, do you want to say a bit more about ONTAP?
Absolutely. Thank you, Susanna. So yeah, on our next slide, Rahul, we've got some information about ONTAP. Now, ONTAP is a database of information. And sorry, Rahul, could you just move us to the next slide, please? Thank you. So it's a database of information really to help companies looking to take their equity plans, their ESOPs, outside of India into new countries. And indeed, for any company around the world, once they move outside of the country, perhaps they're headquartered in, legal and tax issues start cropping up. Rahul showed the regulatory framework earlier in India. Unfortunately, the regulatory framework in every country around the world is different. So how do you manage that if you want to take your ESOPs globally? You can go to local lawyers in every country, but that can be very expensive. So what ONTAP does is provide a database of information to make that more cost effective. It's in over 150 countries. It's updated by a global network of share plan specialists. It covers legal information, so securities laws and foreign exchange issues, but also tax information. So we've found lots and lots of companies have really benefited from employee tax notes, information that you can give to your employees that tells them what tax is due in relation to their equity awards, when the tax is due, how they might have to do any reporting of tax. Similarly, there are guides for payroll teams. We could talk about ONTAP for a very long time. You can get demonstrations from the Capita team or from us. And what we can do is offer subscriptions to the site or standalone reports. So you can get a one-time legal and tax report or a one-time employee tax note. It's a really useful tool to get global legal and tax information. And as we say here, if you've got any questions about it or want to see more of it, please do let Susanna or myself know, or any of the Capita team know, as we've very proudly partnered with Capita to bring ONTAP to new regions and new companies. That's it about ONTAP. We'll now talk about some global legal and tax issues and recent updates. And Susanna, I think you're back on this.
Absolutely. Thank you, Tom. So we're going to start off by just taking a quick turn around the globe and look at the key different regions and the sort of trends that we are currently seeing in those different regions around the offering of equity incentives. So in the Asia Pacific region, equity plans are increasingly being offered in a variety of jurisdictions. But I think the key thing here is to plan well ahead to keep on top of compliance actions. There are complex and time-consuming approvals, registrations, consents, or disclosures required in many of the countries here. And whilst that doesn't mean that you can't offer equity to employees, it just means that to do it compliantly is going to take a little bit longer to get those things in place. If we move now to the US, equity incentives have been well established in the United States for quite some time and continue in widespread use as part of a typical compensation package. But that doesn't mean it's entirely straightforward. There are some key points to work through in the US, particularly on the securities laws side of things at both federal and state level, and also on the tax side. And some of you may well have come across Section 409A, which is targeted at deferred compensation and generally is one that you will need to consider when offering some form of equity compensation. So moving on.
Yeah, looking at our next region generally, we've got Latin America, where Susanna said for APAC, plan ahead is probably the key message. For Latin America, I think perhaps it's document things clearly. What we find in Latin America is it can be quite restrictive for equity plans. The tax position isn't always clear. You know, where India perhaps has quite clear rules on taxing ESOPs, in certain Latin American countries, it's quite a new concept. So the tax position isn't necessarily obvious. There can be some restrictions from a foreign exchange perspective. And it's a very employee-friendly country. So when I say document things clearly, what we want to avoid in many Latin American countries is local laws, local employment laws attaching to our equity awards. And if you document things carefully with sufficient and appropriate advice, you can often make sure your equity awards don't get caught by local employment laws, which can be helpful to the company. Our last region that we're talking about generally is Europe. Europe is a location where employee equity is generally very popular. And compliance, so the legal and tax issues, are typically quite straightforward. We see this in the UK and many other countries in Europe. That's not to say it's all straightforward. There are sometimes filings in countries such as Poland and Bulgaria, but actually most countries in Europe are trying to make equity easy. What we also see is tax advantage plans. So an ability for your employees and sometimes the company as well to get certain tax benefits if certain rules are followed. And we see that in a lot of European countries, including those we've mentioned here. So the likes of UK, where we have 4 different tax advantage plans, Ireland, where there are a few, France, Germany, and Spain. Also countries where if you would like to explore it, it's possible to get tax advantages with your equity plans.
Great. So we're going to move on and look at some specific updates in just a moment. But in terms of thinking about that compliance piece in general and how you stay on top of compliance for legal and tax considerations, I think a particular thing to bear in mind is that the most common changes are going to be around tax. In a lot of countries, tax rates may change every year, or at least will be reviewed every year. For a lot of countries, that happens on the 1st of January. So around the change in the calendar year is a good time to revisit the tax rates. But we've put a little map up on the slide here. The purple countries have tax rates changing on the 1st of January, but you'll see that the yellow countries have different times in the year when the tax rates change. And actually, those of you in India and those of us here in the UK will be used to rates changing in April, but there are quite a few other countries just to bear in mind where those tax rates might change at different points in the year. So if we flip on to the next slide, we're going to start on some of our more specific global updates. Tom.
Thank you. And yes, Susanna said earlier with APAC, plan ahead. APAC is not necessarily the easiest region to roll out your global equity plans. It's not impossible, but certainly in Vietnam and Philippines, planning ahead is sensible. So in Vietnam, historically, you needed to get consent from the State Bank of Vietnam, or approval. So State Bank of Vietnam approval to roll out your ESOPs in Vietnam. As of August of this year, that's no longer required, but it's not really easier. It's just the requirements have changed. You still need a special account set up, which the State Bank of Vietnam ultimately need to be involved in. And you can't make outward transfers. So if you have a plan, for example, where you need people in Vietnam to send money back to India, that's going to be prohibited. There's also reporting requirements. And in practice, what this means is the sorts of plans that can be offered in Vietnam are quite limited. So free share plans or shares where there is a purchase, but no transfer of money out of Vietnam. So quite a tricky country. In the Philippines, things are a little more straightforward, but still planning ahead is really important. All employee share plans require a confirmation of exemption filing from the Philippines SEC, the Securities Exchange Commission. So you need to get this formal approval in the Philippines as well. That's been in place for quite a long time. But what we've seen at Tapestry with our global clients this year is much more scrutiny from the Philippines regulator. They're asking for more information, more disclosures. They're asking questions of issuers. And in some cases, they're applying fines where perhaps information hasn't been submitted on time or hasn't been submitted correctly. So these really are 2 countries where if you are looking to roll out your global ESOPs, you should do so carefully and make sure you speak to your advisors.
So we're back to the US, and as I mentioned earlier, there are some securities laws considerations if you're offering equity to employees in the United States. You will need to look for an exemption at federal level so that you don't have to publish a prospectus, and there may also be state level requirements as well. So plenty to think about in the US. These rules haven't changed significantly recently, but similar to the position that Tom mentioned in the Philippines, we have noticed the regulators, particularly at a state level, taking a slightly more detailed view and asking more questions. So, for example, as part of the practical process of submitting filings, we have had cases where clients have had these rejected because of some failures on the service of process form. So this is really into the detail of how they're achieving the filings and the required disclosures. But I think the message here is, even if you have done this before and you're reasonably confident with the process, it's always as well to take some updated advice or consult on the most up-to-date position, as there are some practical points that change even when the basic rules stay exactly the same.
So as we move on, we've got a few tax updates as well. I mentioned earlier that in Europe, things are quite straightforward. That's not to say that they don't change. So here we've got two changes, either recently or upcoming. So in Slovenia, there is currently no withholding for your equity income, your ESOPs, where they are granted by the foreign company. It's really normal that that's what happens. If you're an Indian issuer, we would expect the Indian company to grant the awards and the participants in, say, Slovenia to benefit. So the foreign company is granting the awards. Currently, there's no withholding. There's no need to hold back some value of the share awards to cover tax. However, there's a proposal that from 2025, there will be withholding of share plan income. That's a change that we see in a few countries as they tend to develop. They tend to realize from a regulatory perspective, withholding might mean we can get a fairer amount of tax recovered. We'll watch this space. We'll let you know and our network know as and when this comes in, but certainly one we're keeping our eyes on. In the Czech Republic, we've seen an interesting change earlier in 2024. What's happened in the Czech Republic is that taxation has essentially been deferred. So for a RSU style award where you receive shares, it used to be that you would just receive tax when they vest, or for perhaps a purchase plan, you might get taxed at the point of purchase, for example, if there was a discount. That's changed in the Czech Republic, and the taxation is now deferred to certain trigger events, for example, when the shares are sold, when someone terminates employment, or 10 years after acquiring shares. And it's the earliest of those events that takes place, but it's been deferred later than before. Now, this is probably nice for employees, but is causing issues for employers. Companies have to track this, and it's quite hard to know when the tax is due. And what we've seen is a lot of challenge from companies in the Czech Republic and from advisors. So our council, our law firm that we work with in the Czech Republic, are part of, various bodies who are challenging this and hoping that this is reverted. And what we now think is that there might be in the future some choice for the employer to decide when the tax might be due. It's another one that we'll be keeping our eyes on. I think we've now just got one more slide of tax updates from you, Susanna.
Absolutely, thank you. So we are finishing off with a quick look at developments in the UK. The first thing I'm going to mention is an exciting new development, which is the opening up of a private company trading platform in the UK known as Pisces. This will go ahead from May next year, 2025. It potentially provides a liquidity opportunity for unlisted companies also in relation to their employee share plans. At Tapestry, we're very happy to be supporting the relevant government departments with their understanding of the employee share plan considerations around this. So we're really excited to see how this is going to develop. And then just to finish on tax in the UK, we had a new government in the last few months, and they have published their first budget. Unsurprisingly, we had some tax rises in that budget. And I think the key ones to note for employee share plans is that the participant rate of capital gains tax is increasing. But the largest increase is probably to the employer social security costs. And this is not a share plan specific issue. It will apply across the board to remuneration paid to the workforce, but it will have an impact on the cost of operating share plans. And I think one thing to bear in mind if you're offering plans in the UK is whether you can look at one of those tax advantaged plans that Tom referred to earlier, because very often that will help to manage the employer national insurance cost around operating employee equity. So that's the end of our very quick canter around the globe. We're always happy to take questions. You have our contact details on the slides. You can get in touch with us via your contacts at Capita as well. And we do offer quarterly webinars where we run through global updates that we've come across. And if you'd like to be invited to those, again, please do get in touch and we can put you on our invitation list.
So thank you, Rahul, and thank you, Susanna. Thank you, Tom. It was really insightful to hear you talking about multiple geographies. I think that's the globe is a small place today. So thank you for your time. Look forward to working with you again on this topic. Thank you.
Thank you. Thank you very much.
Yeah.